Hey, everybody. Welcome back to the Startup Sense podcast. This is your host, Jonah Lupton. Today, I'm bringing you one of my favorite episodes. I haven't even talked to Andy yet, and I already know it's going to be a good one because I followed him for a while. I've listened to many of his speeches before or some of his other podcast interviews, and he's a great speaker. He's actually a career VC, so venture capitalist, spent years with Benchmark and some other firms before starting Wealthfront. Wealthfront is an automated investment service based in Silicon Valley. They've raised $129 million from investors, a whole bunch of individual angels, as well as some institutional investors, about 140 people strong right now, and $6.8 million of AUM.
Billion.
Oh, billion. I mean, woo, glad you caught me there. 6.8 billion of AUM, which is assets under management. So let's welcome Andy to the show. Andy, how are you?
Thank you very much. I'm fine. I'm a little scared after the million, but other than that, I'm in good shape.
You guys probably had that in the first couple of weeks. So talk to us about, when did you start Wealthfront?
Well, we started the service as it's currently comprised in December of 2011, so a little bit over about 5.5 years ago.
Okay. And I mean, I'm sure it's been one heck of a ride. You started it with your co-founder, Dan Carroll, correct?
Correct.
How did you guys know each other?
We didn't. I actually had an idea for the business that came out of my involvement on the University of Pennsylvania Endowment Board. And basically, I noticed that, as you're aware from having worked in the investment business, the premier university endowments are probably the best managed large pools of capital in the world. And one of my responsibilities as a trustee at Penn is to sit on their investment committee. And I noticed that the way that our investment team made their investments was pretty arcane in terms of the tools that they used, and that if one could automate what they do in software, we could actually democratize access to really sophisticated financial advice. So I thought, hey, I could do a social good by doing this, and I set out to start the company because I was motivated by the social good. Now, one of my former students, I also, for the last 12 years, I've taught at Stanford Graduate School of Business. And one of my former students really wanted to make a business out of what I was doing as a hobby and kept pushing me to start a company, and noticed that Dan had started something similar that had gotten quite a bit of traction. So he kept encouraging me to reach out to Dan. I finally did, and Dan and I came to an understanding that we should start the company together.
Fantastic. Who took the CEO position first?
I did. Dan wanted me to do that because he doesn't want to have that responsibility. He's a phenomenal product guy who has an amazing feel for our customer, but he didn't want to have the responsibility of having to manage people.
Were the majority of the early team members that you hired engineers that needed to build the software and the automation?
Yes, and still today, 60% of our employees are engineers, which is unlike anything in the financial services industry.
Oh, of course, absolutely. Now, how did you find those engineers, and did they need to have a background in investments or finance?
Well, we found them through classic recruiting techniques, a lot of referrals, a lot of outreach to people who we thought could be ideal people. We specifically don't want them to have financial background. We have an elite team of researchers who are PhDs from premier universities in economics, operations research, and statistics, and machine learning. And our research group are the ones that have the expertise in finance. They're the ones who conceptualize and spec our products, and the engineers implement them.
Now, I mean, I've been away from the investment business for a little while now, but certainly it's no secret that hedge funds and big traders are using algorithms and whatnot more now than ever before. Is part of what you guys are doing, the automation that you talk about, is part of that algorithms?
Well, I think there's a misunderstanding about the term algorithm. So the hedge funds that use algorithms are ones that are trying to use new methods to find signal among the noise. They're looking for information in all of the trading history that can help them find stocks or securities or assets that are inappropriately valued. That is the exact opposite of what we're trying to do. We're focused on passive investing or index fund based
Okay.
investing. We
Gotcha.
use tried and true methodologies that have been used by the best financial advisors for decades, and we just implement that in software. So we're not trying to do cutting edge research to find new algorithms as a ways to make money. We're using, what most people don't realize is the vast majority of financial advisors all use exactly the same software. It's called mean variance optimization to allocate your portfolio. So all we did was take away the step where your advisor actually had to run the software and then execute the trade. Computers are much better at routine tasks than people are. We just took those routine tasks out.
Gotcha. Who is your ideal client?
Someone who's under 40 with less than $1 million who wants to delegate the management of their portfolio.
Okay.
So the reason why we have those three requirements are, number one, we deliver a solution that we think is ideal for young people. So in contrast to the typical client of a financial advisor who's older and wants to talk to someone, we're serving a younger audience that doesn't have enough money to access financial advisors if they want to delegate. So typically, financial advisors have a minimum account requirement of at least $1 million, and that's to make their economics work so they can earn a very high salary. If you have even $300,000, you typically won't qualify to be able to have someone manage your money on your behalf. Those are the people that we want. Now, because we're focused on young people, they would much rather have everything done for them electronically than have to talk to someone. So I'm 58, someone my age prefers to talk to someone. Someone in their 20s and 30s, quite the opposite. As a matter of fact, our clients tell us we pay you not to talk to us. So we're focused on the people that the traditional industry absolutely doesn't want.
Gotcha. And a big part of this is because of the automation, you're able to charge less in fees, right?
Well, what's even more important is that we're able to offer it at minimums as low as $500.
Wow.
So we can give you the sophistication of what you might find from a private wealth manager. That's a financial advisor who has a $5 to $15 million minimum. We can give you most of what they do at a $500 minimum. Our fees are approximately a quarter of what they charge. So the average fee charged by a financial advisor is about 1%, and we charge less than 0.25%.
Now, I'm sure you guys have you've run the numbers, and I'm sure this is part of your value strategy. If someone has $250,000 or maybe even $100,000, and they're paying that financial advisor 1 to 1.5% a year versus paying 25 basis points or 0.25% with Wealthfront, after 15 or 20 years, the fees, that extra 1% in fees, has gobbled up a ton of their money, correct?
Half.
Wow, incredible.
But that's just the fees. We also do some best practices in terms of minimizing your taxes, and the value of the tax savings are 3x the value of the fee savings.
Wow. Just by me holding on to long-term capital gains and tax harvesting.
By doing tax loss harvesting.
Right. Okay. I mean, and ETFs themselves are considered to be very tax favorable investment vehicles, right?
Correct.
Okay. Versus your mutual funds that are actively trading or whatnot.
Right. So there are a number of ways that we minimize your taxes, but if you add all of those ways up together, the value is at least 3x the amount that we save you on the fees, and that's the story that most people don't hear.
So in addition to doing interviews on podcasts, how else do you get the Wealthfront name out there? How are you acquiring these customers?
Well, the primary way is through word of mouth. So it's organic growth. When we started, we built our business model, or we modeled our business model after Dropbox. Since we were targeting young people, and our initial niche audience that we wanted to build a beachhead with were young people who worked in tech. Hold on a second. Forgive me.
Yep, no worries.
So we were working with young people in tech,
Okay.
and we figured that if they worked in tech, they were much more used to an internet business model than they were a financial services business model. So our target audience pretty much hates Wall Street. And the classic Wall Street business model is to have a very high fee for a small amount of money or a small amount of assets, and have the fee decrease as you give them more money. Well, that seems really unfair to the people who don't have much money. In contrast to the classic, the internet business model is a freemium business model where you give someone something for free, and then if they're willing to go all in, you charge them a fee for that. So what we did was model ourselves after Dropbox, and just as Dropbox started by offering 2 gigabytes for free for everyone who signed up for an account, and for everyone who you invited, you and the invitee got another 250 meg managed for free. In our case, we give you the first $10,000 managed for free, and then we only charge 0.25% thereafter. And for everyone you invite to use the service, you and the invitee get an additional 5K managed for free. So if you invite 5 of your friends, you're now up to 35,000 managed for free. So our invitation system is about 1/3 of our new client acquisition. Physical word of mouth is probably another 1/3, and we do a very little bit of advertising, and that's only about 10% of our new client growth.
Okay. So when you say advertising, different forms of digital marketing?
Yes.
Okay. You guys don't have any offices around the country, do you?
There's no need because there's no one to talk. I mean, we have technical support, but our clients don't want to talk to people.
Hey, I totally understand. I mean, this is one reason that Amazon has become so popular. People just want to order their stuff and have it shipped to their house. They don't want to walk to a store and talk to anybody.
I think most people would say that Amazon offers better service than your neighborhood bookstore.
Absolutely.
And that's because of the value in the product. That's what we're attempting to do.
So I've had a couple guests on that have raised over $100 million. Wealthfront is now one of them. Talk to us, tell the audience why a company would need to raise that much capital. What is it all going towards?
Engineering.
Okay.
So we have over 80 engineers. An average engineer salary is probably $170,000 or $170,000, and then with benefits that adds another 15%, so over $200,000 per person. So if per year, so if you have 80 engineers, that's quite a bit of money.
Right, and you're talking probably $20 million in salaries just there.
Exactly, and so what we're doing is we're building a really, really compelling product. And this is a classic tech approach to building a business, which is very different from the non-tech approach, which is to bootstrap and to grow within your profits. That's not a great way to win a big market. If you want to win a big market, you build a superior product, and then with time, you gain scale. And fortunately, venture capitalists have made a lot of money continuously taking that bet, where they're willing to invest in developing a superior suite of services. And over time, people come to recognize the superiority of that suite and will bring you more and more assets and more revenue, and ultimately you make a profit. And that's a really, really hard thing for people who are not from tech to understand. And fortunately, it works really well, which is how I'm in a position to do what I do today.
Now, when you're only charging a quarter of a percent, you need a ton of money under management in order to build a profitable business. So how close are you guys to being a profitable company?
We're probably a little less than 2 years away from doing that because we're growing so rapidly. So this year we're growing at about 100% annualized rate, which last year we ended with about $4.6 billion under management. And if you keep growing at that kind of rate, then we get to profitability in less than 2 years.
I mean, there are hundreds of billions, actually, I think trillions of dollars invested in mutual funds and ETFs and other investment vehicles. How large can a business like this get, you think? And maybe where do you see the company in 3 to 5 years?
Well, we think a great analogy for what we're trying to do is what Charles Schwab did in the 70s. And Chuck Schwab himself pointed this out to me. In 1974, the U.S. government deregulated commissions. So up until 74, everyone paid the same commission no matter what firm you worked with. Schwab saw an opportunity post deregulation to charge a much lower commission, but the only way he could do that was to radically lower his cost base to deliver those commissions. Now, prior to the availability of a discount stockbroker, the only way to make a trade was through a broker with whom you had a personal relationship. Now, what Schwab did was to build a phone bank of advisors who were nameless and faceless on the other end of an 800 number. It seems odd today, but back in 1975, that was a radical idea. Not knowing the person that you were placing your trade with, which was a really important financial transaction, was wacky. And so the only people who were wacky enough to try such a service were young people. Well, the average age of a Schwab client in 1975 was 32, which is exactly the same as the average age of our client, who's wacky enough to have their money managed by software. And the average income and the average net worth, inflation adjusted, were exactly the same for Schwab in 1975 as they are for us today. Over the ensuing 42 years from 75 to 2017, the average age of a Schwab client grew by 26 years, from 32 to 58. So what that tells me is Charles Schwab grew with the baby boomer generation. Now, the beauty of growing with the baby boomers is that they were in the wealth accumulation phase of their lives, not the wealth preservation phase of their lives. So they continuously added to their account as they saved money. And by doing that, Schwab ultimately has grown to $3 trillion of assets under management.
Wow.
Now collectively, baby boomers have 16 trillion managed on their behalf. The numbers are mind-boggling. They're so large. Now, if we can do the same thing for millennials, who are a bigger generation than baby boomers and who are likely to have more wealth ultimately than baby boomers, then we think that we can ultimately build as big a business as Schwab. The best news for us is that our service is being adopted at more than twice the rate that Schwab was. Even inflation adjusted, we're being adopted at a faster rate than Schwab was. So that bodes really well for us.
Because those baby boomers at some point are going to begin transferring that wealth to the millennials.
Well, that and the millennials are starting to make money. You know, everybody thinks of millennials or millennials are often characterized as slackers who live in their parents' basements. That's not true for all people under 37. There are a lot of them that are doing exceptionally well, and the numbers that we see say that collectively millennials have about $3 trillion of investable assets. They're not yet invested. They're almost exclusively kept in bank accounts. But that money is ultimately going to get invested, and as those people continue to grow their incomes and save more money, we think that their invested assets will grow well beyond 16 trillion.
So I think one of the most important parts of an automated investment service is that it takes the emotional, reactive, responses out of the decision-making process. And what I mean by that is, I used to have these fancy charts that showed, that the average retail investor, typically performed well below the averages because they would buy at the highs and they would sell at the lows.
Right.
Versus investment, these automated investment programs driven by software that doesn't have, any emotional attachment to the performance and the ETFs and sectors and asset allocation and all that stuff. So how important is that part, is taking the emotion out of it and giving these people a chance to actually perform like the indexes?
Well, there have been numerous academic studies that have been done on that phenomenon, and they have shown that the bad behavior of retail investors, namely buying when the market goes up and selling when the market goes down because it feels right actually costs the average investor anywhere between 1.5% and 3.5% every single year.
Yep, I believe it. And then I've also seen charts that if you're an investor and you miss just the top 10 days of the year, you've lost 50% of the gains for the year or something. And that's
Exactly.
Average retail investor. That's what typically happens.
Right.
Things start to go bad, they freak out, they sell everything rebounds, it's on the way back up, and they buy. And a lot of times they're buying higher than where they sold it. So
What surprises a lot of people about our clientele is that they don't run for the exits when the markets decline. So our withdrawals are not at all correlated with market performance.
they have to trust the process. And I
They
mean,
do.
back to your earlier point, that's why endowments perform so well, is because they have a process and a strategy, and they don't stray from it when things get really good or really bad.
That's an underreported view, absolutely.
What have been the biggest challenges? You guys have been at this now for 5.5 years. You've gone from nothing to 6.8 billion under management. What have been some of the big challenges?
I would say the biggest challenge is finding the talent to implement all of our great ideas. It's recruiting.
Yeah. Do you still play a part in that, or?
Absolutely.
Okay.
I have 3 interviews today.
Wow. Mostly technical people?
Yes.
Okay. So still bringing in the engineers. Where do you guys have a favorite company to hire from? Or, I mean, I don't know, any tips or tactics you can share with us?
Because you want to have a mix. You want a culture that doesn't reflect the culture of another company. It's much better to drive diversity.
And what do you think is the biggest attraction to Wealthfront? Why would an engineer leave another startup or company in the Valley to join Wealthfront?
Well, first and foremost, engineers like to work in engineering-driven cultures. And the best proxy for whether or not a culture is engineering-driven is that the engineering function has more people than any other function. The power is always in the number of people. And so what you find is companies that are driven by product have more people in product than the other functions. Marketing, operations, support, it's all consistent. And so 60% of our headcount is in engineering, and that's really, really clear to great engineers. Another thing that attracts them to us is our mission, that we're very much focused on democratizing access to sophisticated financial advice. We hate what Wall Street does to people. We hate that they have high minimums in order to access great advice. We hate a bunch of the nickel and diming fees that goes on and the obfuscation that goes on. And everyone who joins us is very much attracted to the idea of changing that.
So you have one of the most impressive lists of investors, from Tim Ferriss to Marissa Mayer to Mark Andreessen, Hunter Walk, Ben Horowitz, Andy Dunn from Bonobos just sold his company to Walmart. I mean, the list goes on. And then VC firms like, I'm assuming Andreessen Horowitz is probably in there, and you got Greylock and Reid Hoffman. So, I mean, I only rattled off half of the names. How did you get all these incredible people to believe in this idea? Is it from your previous relationships with them as a VC?
Well, I think that gave me the at-bat. That gave me the opportunity, but they were compelled by the opportunity. They all saw the opportunity to disrupt what we all hate as an industry, which is financial services.
You didn't spend any time in financial services, right? I mean, like Wall Street, investment banks.
I did actually. I spent 2 years in investment banking after college.
Oh, okay. That was what, back in the 80s?
80 to 82.
Okay. Is that firm still around? I know a lot of firms at Wall Street have gone under, that's for sure.
Well, the firm was called Blythe Eastman Dillon. It was acquired by Payne Weber, which then was acquired by UBS.
Okay.
So it's a piece of a piece of a piece.
A lot of acquisitions too.
But after I left, they called it the House of Pain for Payne Weber. It was a pretty bad place.
Yeah, I worked for Morgan Stanley, which was a roll up from Dean Witter and a whole bunch of other firms too. So,
Mhm.
and then even Morgan Stanley and Smith Barney, have combined forces. So it's
Right.
Wall Street certainly changed a lot over the last 30 or 40 years.
Well, it
Uh,
has in many ways, and in other ways it hasn't, which is putting their own interests ahead of the clients.
so you're obviously surrounded by a lot of amazing entrepreneurs and investors. You've been doing this a long time as on both sides of the table. If someone came to you and they were looking to start a technology business, I mean, pick any sector you want. What are some of the pieces of advice that you would give to them? I mean, what do they need to know going into a startup?
Well, first and foremost, great ideas find you. You don't find them. I think that there's a tremendous misunderstanding about how one finds a great idea. There's a perception that entrepreneurs analyze a market, look for a hole, and develop a solution to a problem. That's not what leads to great companies. That leads to very mundane little companies. The truly superb companies, the franchise companies that you know about, are almost always an instance of a technical entrepreneur sees an inflection point in technology that allows a new kind of product to be built, and then they find a market that wants the product. So you start with a product and find the market. You don't start with the market and find the product. So how is that going to happen? Well, you have to be incredibly authentic to the opportunity to see the change that creates the opportunity. Because out executing your competition is not a likely path to success. I teach a class on a concept that I'm quite passionate about, which is product market fit. And the summary of the class that I teach at Stanford is you need to uniquely address a market of desperate users if you hope to succeed. Because if you just offer something that's better, no one will care. Consumers will go with good enough from an incumbent. Better doesn't matter. They have to be desperate. And the only way your potential customers are desperate is no one serves them.
Now, as we've talked about, you guys have raised a bunch of money. I think you told me in the pre-call that you guys haven't raised any money in 2.5 years. How does an entrepreneur balance growth versus, burn, and when to get aggressive with marketing and maybe when to slow things down?
I'm a big believer that product market, you can tell. People often ask me, how do you know that you have product market fit? And I tell them, when you have exponential organic growth. Now, you can game growth with paid marketing, with things like advertising. But if those people don't stick and they don't ask their friends to join them through word of mouth, then that's not sustainable growth. So the only thing that I care about is organic growth.
Okay. I mean, in terms of questions, that's pretty much all I got for you, Andy. What did we skip over? Any topics or areas of the business that you wanted a chance to talk about that I forgot to ask about?
No, I mean, we didn't talk much about Wealthfront in particular, that not only do we offer the ability to do a superb job of managing your portfolio, but we also do financial planning in an automated fashion. And we're also starting to get into banking services. You can now borrow up to 30% of your account value at interest rates well below what you can get anywhere else, even well below home equity line of credit. So you can, depending on your account size, you can borrow at 3.25% to 4.5%.
Oh,
So,
fantastic.
so what we're trying to do is take all of the services that are traditionally only made available through private wealth managers. Those are financial advisors who serve very wealthy clients with minimums of 5 to 15 million. Automate what they do with software so we can deliver them to the masses. So someone with as little as $500 has access to great investment management, great financial planning, and great banking.
Talk to us about what is the process for signing up. So I would go to wealthfront.com, and then what would I do after that?
Well, you'll take a 6-question questionnaire so that we can evaluate your tolerance for risk. We don't ask you what you think your risk tolerance is because almost everyone overstates it. There's a lot of behavioral economics research on the topic. And based on our assessment of your risk, we'll recommend a portfolio that we'll buy on your behalf. And then you can either take our recommendation and go implement it yourself in your own brokerage account and pay us nothing, or you can pay us our very, very modest fee for us to do it on your behalf in a very low cost and very tax efficient fashion. And also we can help you with your planning for retirement. We can help you with your planning for college. Literally, we can tell you what it's going to cost for your kids to go to any particular college, what kind of financial aid you might qualify for. You can't get this anywhere else on the internet. And soon we'll even have planning tools to help you figure out how much home you can afford to buy in different neighborhoods. And then lastly, we'll offer a suite of banking services.
And I assume that you also encourage your clients or customers to add money to their account as frequently as possible, some sort of like an auto invest program on a monthly basis, or maybe even more often than that.
Sure. Well, we have a recurring deposit feature where you can pick the frequency with which you want money to automatically be transferred from your bank account to your Wealthfront account, or you can do it on an episodic basis.
And how often should people come back and update those 6 questions to determine if their risk tolerance or time horizon or anything has changed?
Well, the only reason to update your risk is as you age, and we do that for you automatically, and as life events change. So as you have children, as you get married, it's when you reach significant milestones in your life. You shouldn't change your risk tolerance based on where the market is. That's the equivalent of doing that bad behavior that you described before. So just as buying when the market goes up and selling when the market goes down can be disastrous for your returns, decreasing your risk when the market goes down and increasing your risk when the market goes up is exactly the same behavior. So you don't want to change your risk tolerance based on current events. You want to change it based on life milestones.
And do you have an investment team that helps determine which ETFs are going to be bought and when?
Yes, we have a research team of elite PhDs that does all of that.
Okay, perfect. Well, Andy, thank you so much for joining us today. Really, really appreciate it. I know you do a little bit of stuff on social media. What's the best way to connect with you online?
Well, we have a blog at Wealthfront, which can be found at blog.wealthfront.com. And if you need to, you can always email me at andy@wealthfront.com.
Awesome. Thank you so much, sir. Really appreciate your time today. Wish you guys the best. Obviously, you're crushing it already, and I have no doubt that will continue. And look forward to staying in touch with you.
Thank you very much.
You got it. Talk to you soon. Bye, Andy.
Bye-bye.